Have you ever wondered how traders profit when the stock market falls? Well, in this video, we're going to talk about that. But let's go over the basics first. Let's say when the price of the stock is rising. And let's say a stock trader decides to buy the stock at $20. And then the stock rises to, let's say, 100, and he decides to sell it at that price. So his profit or his gain is going to be $80. And that's how people make money in the stock market. You buy first and then you sell later. Well, when the market goes down, the order is in reverse. You sell first and then you buy later. So a stock trader, they will sell a stock at 100 and then buy it back at a lower price, let's say at 20. So the profit will still be the same. This person will get a gain of $80. And this is known as shorting the stock. So that's how a trader can profit when the market goes down. Now you might be wondering, how do you sell a stock that you don't own or that you don't have in the first place? And the idea is that you borrow a share from your broker, which he may borrow from someone else. And so you borrow a share, you sell it, and then later on you buy it back when the price falls. Now, this is not the only way to profit from falling stock prices. There are other ways, which I'm going to talk about in this video. But for now, let's calculate the return on investment for each of these scenarios. So the return on investment is going to equal the gain divided by the original cost times 100%. So with the example on the left, the gain is $80. The original cost or investment was $20. And multiplying that by 100%, we get an ROI of 400%, which is pretty good. Now, let's see what happens when a person shorts a stock. So the gain is still the same, but the return on investment is not. So this person still has a gain of 80. However, he had to put up $100 in collateral because he's borrowing the share. So his cost of investment would be 100. So his return on investment is only 80%, whereas this person's return on investment is 400%. He was able to multiply the value of his money from 20 to 100. Now, on the right side, let's say the person who decides to short that stock, he's only able to make 80% return. He's not able to double his money. His maximum gain is just under 100%. For instance, if he sells a stock at 100 and the stock goes down to a penny, he can buy it at a penny and his gain will be $99.99. If the stock drops to zero, probably it's going to be bankrupt and maybe he'll keep that 100. So at most, his gain will be 100%. It can't be more than that. Whereas buying a stock and selling it, you have an unlimited gain. Your gain can go up to infinity. Now, there are some risks with both forms of trading, and let's talk about that. Now, let's say that John buys a stock at a price of $100, and he's completely wrong about the direction of the stock. The stock tanks, and the value goes to, let's say, $10. And he doesn't want to lose any more money, so he sells the stock at this price. And let's say he owns 100 shares of stock. So his initial investment is $100 times 100 shares, which is $10,000. And now he sells those 100 shares for $10, which basically the value of that is $1,000. So he's at a $9,000 loss. The principal amount that he invested it with is $10,000. So his return on investment is negative 90%. Now, the most that he can lose, his maximum loss, or the amount that's at risk, is what he started with, $10,000. So his risk is capped at what he puts into the stock, which could be small or it can be large. Now, let's look at the other scenario. Let's say Jim shorts the stock, so that means that he sells it first. So he sells the stock at $10, and we're going to use 100 shares again. Now, he's completely wrong about the direction of the stock. The stock goes up, and so he's forced to buy it back. And let's say it goes up to 100. So Jim, he starts with $1,000 of collateral because he borrowed $1,000 worth of shares. Now that the price went up, he has to buy back those 100 shares for $100. So he has to pay $10,000 to return those shares to the person he borrowed it from. So he is looking at the same loss. His loss is $9,000, just like John's loss. However, his initial investment was $1,000. And so his ROI is much greater. 9,000 over 1,000, that's 9 times 100%. He's looking at a 900% loss. His maximum risk is unlimited. Looking at John, the most that he could lose is 10,000. Jim can lose more than 10,000. Let's say if the stock went up to $500. Chances are he'll receive a margin call before that happens, but let's say it goes up to that price. So that means he has to buy back 100 shares at $500. So he's going to owe 50,000. When initially he started with 1,000. So imagine shorting the stock at $1,000 and owing 50,000 later. So that is the inherent risk with shorting stocks. Now let's review some basic lessons that we've learned in this video. When a person buys a stock first and then sells it later, the maximum gain that person can experience is virtually infinity. Now, it takes some time for stocks to go up. Stocks tend to go up slowly, and so you may have to wait a long time. The maximum risk is limited to the principal. In the case of John, his maximum risk is only 10K. That is the most that he could lose, but he can gain a lot. Let's say if the stock goes from 100 to 1,000, he could have $100,000 in stock, where he only started with 10,000. Now, in the case of Jim, when a person sells a stock first and then buys it later, the gain is limited to the principal that you started with. In this case, his cost of investment was 1K. So that's the most that he can make from this trade. Now, the losses, his risk, is unlimited. As we saw in this example, he shorted the stock at $1,000, but he could potentially owe 10,000 or 50,000 depending on how fast the stock moves up. In most cases, stocks tend to rise slowly in price. Sometimes they can gap up with big news, but for the most part, they tend to rise slowly. Now, when a stock falls, generally speaking, it usually falls fast. And this is why a lot of traders like to short stocks, because they can make a lot of money in a short time. But sometimes a stock can also decline progressively. But a lot of times when a stock falls, it tends to fall down fast because of the fear and panic that's in the market. Now let's talk about other ways in which traders can profit when stock prices fall. And this has to do with options. When the price of a stock is going up, the value of call options increases, whereas the value of put options decreases. When the price of a stock is going down, the value of call options decreases, but the value of put options increases. So this is another way in which a trader can profit from falling stock prices. If you buy a put option, when the stock prices fall, the value of your put option will increase. Now let's begin our discussion with call options. So let's say that the price of the stock is currently trading at $50 and John decides to buy a $5 call option with a 30-day expiration at a strike price of $47. Now, this option contract gives John the right to buy the stock at 47. So what this means is that he can exercise this option contract to buy shares at 47 and then go to the market and sell it for 50, which will give him a $3 profit. So this $5 call option has two components. It has $3 of intrinsic value. That's the difference between the price of the stock and the strike price. And the remainder is the extrinsic value, or basically the premium of the stock, also known as the time value of the stock. This part of the stock will decay with time. 30 days later, if the price of the stock doesn't move, this part will go to zero, and the $5 call option will be worth $3 if the stock remains at 50 bucks. So those are the two elements of call and put options. The two elements are the intrinsic value, which doesn't decay with time, and the extrinsic value of a stock, which does decay with time. So at expiration, this $2 portion will go to zero. So just keep that in mind. Now let's say that the price of the stock rises from $50 to $100 at expiration 30 days later. What will be the value of the call option? So the call option is currently 5, but when it goes up to 100, the value of the call option will be the difference between the stock price and the strike price. So 100 minus 47, that's 53. And at expiration, the time value of the call option will go to zero. So that $2 will disappear. Now, each call option or each option contract represents 100 shares. So buying a $5 call option represents an initial investment of $500. And selling it at $53 times 100 shares, he's getting back $5,300. So the net gain is $4,800 on his trade. So that's how call options can be profitable if the stock moves up in the right direction and in the right time frame. So the return on investment here is going to be, let me get my calculator out. And this is the one day I forgot to bring with me. But the return on investment should be 960%. If my mental math is correct. Now let's think about this. The most that John can lose, his maximum risk, is only $500. However, his gain is more than 100%. His gain is theoretically unlimited, which is the same as buying the stock and selling it later. Now, on the other hand, on the right side, a put option is very similar to a call option. The risk is limited, but the gain is unlimited, which is not the same when you short a stock. Now let's focus on put options. So let's say that the price of the stock is currently $100, and Jim sees that the stock price is falling, it's declining. So to take advantage of that, he wants to buy a put option. So he buys a $7 put option, and let's say the strike price is $104. So what does that mean? This means that he can sell his shares at $104 if he chooses to exercise that right. He has the right to sell those shares at that price. So what he could do is go to the market, buy the stock at 100, and then sell it at 104. Which means that this option has $4 of intrinsic value. That's the difference between the price of the stock and the strike price. So if it has $4 of intrinsic value, what is the time value or the extrinsic value of this option? It's going to be 7 minus 4, which is $3. So at expiration, if the price remains at 100, this portion of the option contract will go to zero. That's the part that decays with time. Now, let's say the price of the stock drops from 100 to 50. What will be the value of the put option? How much will it be worth? So he bought it for $7, but how much can he sell it for? The value of the put option will now be the difference between the current price of the stock and the strike price. So 104 minus 50 is 54. So he can now sell the put option for 54 bucks. Now, like the call option, the put option represents 100 shares. So buying a $7 put option represents an initial investment of $700, but he could sell it for $5,400, which means he's going to realize a gain of $4,700. Now, these two are pretty close, but because this one was more expensive than what we had here, the gain is a little bit less. Now, the return on investment is going to be a gain of $4,700 divided by the initial investment of $700 times 100%. So that's going to be 671.4%. I'm going to round it to the nearest whole number. So when Jim shorted the stock, the most that he can gain was about 100% of his value, or his initial investment. That's the most that he can make. But by buying a put option, he can make more than 100% when the price of the stock falls. So that's another way in which he can profit from falling prices without the inherent risk that is associated with shorting the stock. Because the most that he can lose is his initial investment. If he buys the put option at $700, he doesn't have to exercise the put option. He has the right to exercise it, but he doesn't have to sell the shares at $104. So his maximum risk is $700. But his maximum gain, like the call option and like buying the stock first and then selling it later, is unlimited. So to review, when the price of the stock goes up, two ways in which a person can profit from this direction is you can buy the stock first and then sell it later, or buy the call option and sell it when the value of the call option rises. Now, when the stock price go down, two simple ways in which you can profit from this move is you can short the stock. You could sell it first and then buy it back later, which can be very risky, or you can buy the put option and then as the stock price falls, you can sell the put option later, which it will be more valuable at that time. So that's it for this video. Now you understand some ways in which traders can profit when stock prices fall.